Hello everyone, and welcome to the online lectures of Dr. D.Y. Patil Center for Management Research. These are lectures for first year students, first semester, and I'll be taking your subject, Economic Analysis for Business Decisions. And today we'll be conducting a lecture on Unit 1, Part 2. Okay, so let's begin with this part. I'll share my screen with you all now. Yes. So let's begin. This is your unit 1, part 2, and we are going to conduct here a lecture on economist theory of the firm. We're going to study about various theories of firm here in this particular unit, right, in this particular video. So according to the first theory is BAUMOL theory. So according to BAUMOL, sales revenue maximization is the most important goal of managers. We all know that if the sales revenue increases, of course the profit will rise. So how the model goes there, like first is static model of sales maximization, which has again two parts, without advertisement and with advertisement, and second is dynamic model of sales maximization. Let's see them one by one. Okay, so static model of sales maximization. So there are few assumptions, as you know that in the economics every law has some assumptions. Only if those assumptions are true, the law is true. So let's see what it is. So given minimum acceptable level of profit, the basic assumptions of the model are: the time horizon of the firm is a single period. The firm is aiming for only that particular period. The certain minimum profit constraint is determined by the market conditions, and demand curve is downward sloping, and average unit curve is U-shaped. So these are a few assumptions that have to be there for the static model to be true. So the first we'll see static model without advertisement. Now, as you can see in the figure, TC is total cost, TR is total revenue, and pi is profit. Okay. So now X1, as you can see, X1, the vertical straight line, it's the output level when profit level is maximum. Okay. And X2 is output level where profit is less than X1, but sales are more. Profit is less, but sales are more. That is X2 level. So let's interpret and observe this particular graph. Now see, the sales maximizer sells at price lower than profit maximizer, of course. The firm will not increase its sales beyond output level X2. Why? Because if profit is less than pi SM, can you see in on the left hand side? That is profit where sales are more, sales maximization profit. So as it will not be acceptable, like to share shareholders will not accept it, and other lending institutions and managers to go beyond that. So this is how a static model without advertisement explains us and helps us to interpret. Now, we assume that sales revenue increases with advertisement expenses. So an oligopolistic firm will prefer to go for sales maximization via an increase in advertisement rather than a price cut, right? So the sales maximizer decides an optimum advertisement by examining its impact on sales revenue, right? So let's read it further. As you all know that TC is total cost. Now, can you see the BC line, the horizontal line? It is production cost. TR is total revenue, pi is profit. That is TR minus TC. Total revenue minus total cost is profit. Pi max is maximum profit. Pi SM is sales maximization profit. A pi, it's given here down. On x-axis, it is advertisement expenditure incurred by a profit maximizer, and AS is advertisement expenditure incurred by a sales maximizer. Now, this implies that with increase in advertisement expenditure, total cost, sales revenue, and hence profit all increase proportionately, right? So production cost shown by BC line. Check out. Can you see BC line, the horizontal line in the first graph? So the production cost shown by this PC line is assumed to be independent of advertisement cost. So if price is such as to enable the firm to sell an output yielding profit above minimum acceptable profit levels, firm will go for higher advertisement expenditure and yield greater revenues, of course. So however, if profit falls below SM, the firm's cost become too high and the firm will cut back on advertisement. So thus this sales maximizer will spend more on advertisement than a profit maximizer. So this is how this model helps us to decide few things. Now, what are the limitations? Assumption of constant price for all product is not realistic. It is a limitation of this particular model. Production cost is assumed to be independent of advertisement cost, and that's not possible. So, however, like with advertisement, the sales increase and physical volume of output increases, leading to economies of scale. A firm already producing at maximum possible efficiency may face these economies of scale. So this will affect the profit, the profit and the cost of production of the firm, whether it strives for sales maximization or profit maximization. So when diseconomies of scale start coming in, of course, everything is affected, right? Let's understand the second one, the dynamic model of sales maximization. Again, this has few assumptions like the objective of the firm is to maximize the rate of growth of sales revenue over its lifetime, and sales revenue R grows at the rate of G%. Okay, you'll get to know in the graph in the next slide that sales revenue is depicted by R, and the rate is depicted by G. Okay. Profit is not taken as the given exogenous variable which act like a constraint in the static. Demand and cost curves have traditional shapes as in the static model. So these are a few of the assumptions of dynamic model. This is the graph. As we've seen that sales revenue is R, grows at the rate of G%. Okay, so the growth function is derived from profit function, as growth of firm is mainly financed by retained profits. So highest attainable growth rate is achieved when profit is maximized, of course. So let's take it further, this graph. Now see point E in the figure represents the point of tendency. It is touching tendency of present value curve to the growth curve. Thus firm will choose GE and RE. Can you see GE and RE? Okay, GE on y-axis, RE on x-axis, to get the highest possible level of S subject to the growth constraint, level of sales. Understood? So again, this law has some limitations. It tries to explain long-run behavior of sales maximizing firm. However, in long-run market, demand, prices or factors of production, etc. change. So this model does not take these changes into account. So these are the drawbacks, limitations of this particular model. Okay. Now the next model we want to study is MARRIS model of managerial economics. Now let's understand what it is about. So its aim, a firm's aim at balanced rate of growth. Every firm aims at that we should grow in a balanced way. And this can be achieved by maximization of rate of growth of demand for a product of firm, that is GD, and rate of growth of capital supply, GS. And to achieve the above growth, management faces two types of constraint, that is managerial constraint and financial constraint. Now let's understand what is managerial constraint. Now look, decision making and planning skills of the manager. Coordination, cooperation, and good teamwork, this requires experience, research and development. These can be managerial constraints. Now, what are financial constraints? Job security, fear of takeover and merger. And to avoid these risks, managers should choose a prudent financial policy consisting of basically three financial ratios that are very important. That is debt equity ratio. It's the value of debt to total assets. Lower the value, better it is. And next is liquidity ratio, total liquid assets to total assets. So ratio is too low, it depicts that risk of insolvency, and ratio is too high, risk of takeover. So the ratio should be balanced. Retention ratio, the third ratio, that is retained profit to total profit. So important source of finance for growth of capital. Look, but firms needs to distribute a part to satisfy the shareholders. So these are the financial constraints that come in place in front of managers. So let's understand this. Now I've given you here a few terms like GD and GS. We have already described in the last slide. What was G was balanced rate of growth. What was GD? Rate of growth of demand for the product. GD, D for demand. And what was GS? Rate of growth of capital supply was GS. Okay. So GD is equal to GS is equal to G. That is the condition of equilibrium. It is seen over here. So rate of growth of demand for the product of firm GD and the rate of growth of capital supply GS. So the condition of equilibrium is GD should be equal to GS equal to G, where GD is function of D and K. What is D? D is diversification of differentiation of product. And what is K? K is success rate of new product. And what is GS? GS is R, means financial security ratio assumed to be constant, proportion of profit. Right. Okay. So this is how it is given in this particular model. Now again, like other models, this model also have a limitation. Now MARRIS assumes cost structure and price to be given, thus profit as given, which is not true, right? MARRIS theory does not account for the interdependence in firms decision making, right? Now look, during industrial slowdown, the manager's aim will be to retain the existing power in the market rather than a balanced rate of growth, right? So during this industrial slowdown process, firm may not be doing well, not because of managerial inefficiency, but because the overall atmosphere is not conducive to a business, right? Next, the last limitation is MARRIS talks about only two constraints. In real life, firm faces a lot of other constraints like social, cultural, environmental, etc. Right? So we in this particular video, we have studied about the theory of firm, like BAUMOL theory, right? It was static model of sales maximization with advertisement, without advertisement, and static model of and dynamic model of sales maximization. And the next theory we said what model we studied was MARRIS model of managerial economics, right? So I'll stop share here. I'll be like uploading this video on my YouTube channel, and if you have any questions regarding the topic we have covered today, you can put up a message in below in my chat box, and I'll get back to you. Okay, so watch this video, and in the next video we'll have more theories of firm. So go through it, watch videos. If you don't understand, watch it again. Okay, and still you have a doubt, you can put up your queries in the chat box, and I'll come back to you as soon as possible. Thank you so much.